Hi all. Today we will be exploring the dynamics of international trade and global finance. So through this class, we will be explaining how countries trade with each other, how currencies influence trade, and how economic systems stay balanced. Okay. And we will also discuss exchange rates, multinational companies, protectionism, and government economic policies. Okay. So all these factors we will be explaining today. So we have a question here. Why nations specialize and trade? What do you think? Basically, countries trade because they cannot efficiently produce everything on their. So we have already learned that for each and every country, there are factors of production and the resources, everything will be varying, right? So they will have some advantage on some production and they will have some disadvantage on producing some products, right? So we have the first concept that is absolute advantage. What is absolute advantage? A country's ability to produce goods at a lower fundamental resource cost than others, right? So where a country can produce goods at a lower cost than another country. So for example, a labor-intensive country like India can produce agricultural products comparatively a lower cost than any other countries. Okay, so we have an absolute advantage on that. So likewise, different countries have different products. Okay. And the second one is comparative advantage. Okay, what is comparative advantage? A country's ability to produce goods at a lower opportunity cost, providing trade is driven by relative efficiency. Okay, which means countries benefit by specializing in products they can produce more efficiently relative to others. So this specialization increases productivity and encourages global trade. For example, let's assume that in absolute advantage. So let's take the production of wheat and rice. Okay, let it be any other thing. Okay, let's take wheat and rice. So if country A has can produce like 10 quantities of wheat with the three labors, and country B can only produce 5 units of wheat with the same labors. And for country A, they can produce like 4 units of wheat with the three labors, and country B can produce 15 units of rice with the 3 units of labor. So in this case, for wheat, country A has an absolute advantage. Okay, so they can produce wheat and make profit. And for country B, they have an absolute advantage on rice production. So they can produce rice and they can export it for profit. But for comparative advantage, it's a kindly different concept. Okay. For example, let's take the case of wheat and rice, or wheat and let's take something else like machines. Okay. So for country A, with let's take capital or labor, whatever it is, let's consider labor itself. So with three labor, country A can produce 10 unit of wheat. And with 3 units of labor, country A can also produce 15 units of machines. Okay. For country B, they can produce with the 3 units of labor, they can produce around 9 units of wheat, and they can produce 4 units of machines. Okay. So in this case, you can see that both in both production, country have A has an advantage, right? So in both cases, they can produce more, but they can produce more of machines than wheat using the same amount of like labors, right? And for B, they can produce more amount of wheat compared to machines. So country A will produce machines and country B will produce wheat. So this is how comparative advantage will work. Got it? Now, let's see the strategic trade-offs of economic specialization. Okay. So economic specialization has both benefit and risk. Definitely, it will be, right? So when countries focus on few industries, they can become highly productive and competitive. So they can have higher efficiency and productivity. However, over specialization can create dependence on limited sectors, right? So if demand falls on resources run out, the economy may suffer. Therefore, government must maintain a balance and a diversity in the economy. Okay. They have to diversify the economy. So what are the benefits? Higher efficiency and productivity, economies of scale, and increased global competitiveness. And what are the negatives? Vulnerability of over specialization, right? And less consumer variety domestically and potential for higher labor costs. So the country should balance it, otherwise it will have it will cause some sort of economic crisis. So specialization is a high reward, high risk strategy requiring careful government management to maintain structural balance. Clear? Now let's see multinational companies. How do they work? And what's their impact on globalization? Okay. So basically, multinational companies or MNCs operate in many countries and play a major role in globalization, right? So they are the businesses operating internationally with increased global influence and trade dominance, right? So they create jobs, introduce advanced technology, and contribute taxes to host countries, right? But at the same time, they may exploit cheap labor, avoid taxes, or weaken local businesses. So while MNCs bring economic growth, government must regulate them carefully. So let's see the benefits and the criticisms. Okay. So what are the benefits? It creates local jobs, bring advanced technology, pay taxes to host government, and achieve lower transport and wage cost. So when an MNC company, whether it is any company, you can take Apple, Microsoft, whatever it is. So when they operate in another country, that particular, the host country have its own benefit. So they will create a huge job market. For example, for a country like India, China, etc., our population is covering almost like the major share of the entire world's population, right? So we don't have enough jobs to support our population. So when these MNC companies are starting their operations here, it will create more job for the people, right? And it will bring advanced technology, definitely, right? For their production, they will have their own advanced technology, so they will import it here and pay taxes to the government. So while they are operating here, as a certain percentage of their profit will be paid as tax to the government, which will improve the government's revenue. Then achieve lower transport and wage costs. So our people won't have to commute to different places, which cost them higher commutation or wage costs, etc. It will be convenient. Okay. But what are the drawbacks of this? First thing, aggressive tax avoidance will be there. Then exploitation of vulnerable workers. That is the major thing, because you know that when an American company is working in India, they will be paying like for the tech world, etc. They will be paying the base or the minimum salary like 20,000 or 25,000, 30,000 for Indian people. At the same time, for the similar job, they are offering like 1.5, 2 lakh, 3 lakh, 4 lakh in their own parent company. They are exploiting the company is exploiting the people. Okay. And then crowding out of smaller domestic firms. So it will destroy the stability of smaller firms in the country because of their operations. Okay, so these are the noticeable issues. Clear? Now let's see what is the difference between free trade and protectionism. Okay. So we'll be comparing them. So free trade allows countries to exchange goods freely, right? Leading to cheaper products, large markets, and economic growth. Right. So, what is free trade? It drives cheaper and better products, opens larger market for producers, and act as a catalyst for higher GDP and employment. Right. At the same time, what about protectionism? Protectionism defends vulnerable young industries, prevents domestic unemployment, stop foreign dumping, and reduces over specialization risk. So basically, when a free trade is there, which means the product can be sold in another country at a cheaper rate because there won't be any taxes that increases the price of the product. So there are some drawbacks for this particular act. some countries might dump their unwanted products or extra products to save their country into our country, okay, which will create some sort of economical issues in uh, the other country's market. For example, just imagine that due to some pesticides or fertilizers, the wheat production in certain country has boomed. Okay, it's boomed and they have more than enough. So just to protect their market, they are simply dumping that extra wheat in India, which will lower the wheat price in India, right? So that will adversely affect the farmers in India. So we can't do that, right? So that is why we have some rules and regulations that called as protections. Okay, so free trade is good in up to a certain extent, but we also need protections. Got it? Now let's see what are the protectionist toolkit. How can we protect our market? So first thing is tax. What is tariff? Taxes placed on imported goods to artificially raise their price and reduce foreign competitiveness. Okay. For example, we know that many products that have produced in our country is also getting imported from other countries, like mobile phones, laptops, dresses, household items, etc. Right. So when the price of imported goods is equal or lower than the domestically made goods, that will reduce the demand for domestically made goods. So it will reduce the income of the domestic producers, right? Thereby reduce the income of government as well. So government can't allow that. That is why they introduce tariffs to increase the price of the imported goods. And second thing is subsidies. What are subsidies? The direct financial grant given to domestic producers to lower their costs and boost the local market share. So when the influence of foreign imported goods are increasing, government will give some subsidies to the domestic producers. So they can reduce the price and thereby they can cover more market share. Okay. Then we have quotas. So this is more commonly seen one. So that there will be some limitation for importing some products. There will be some fixed number. So strict physical limit on the volume of or quantity of specific goods permitted to enter the country. For example, only 1,000 units of MacBook can be sold in an year in a country. That is a kind of quota. Okay. And then we have embargoes. What is that? It's the complete ban on trade with a specific country or specific good, typically for political reasons. So we have heard it many times, right? These products are banned in USA, or these products are banned in UAE or European countries, etc. So it can be from a particular country or some particular brands or products, etc. So these are the commonly seen protectionist tools. Okay. Now let's see what are the stages. Okay. So the stage one is retaliation from partners. So trade wars begin as partners respond to their own tariffs and barriers. And then inefficient firm servers. Okay. So lack of foreign competition removes the incentive for domestic companies to innovate their lower costs. So when there is no competition from foreign products, the government don't have to support the domestic firms as they do, right? So they will be withdrawing their subsidies and all, which will have some sort of impact on the domestic. They will industries like they will have to survive all their own, and then increase the inequality. So higher prices of goods are like disproportionately impact lower income consumers, while sheltered industries concentrate wealth. Okay. So what happens is that when the producers increase the price, some of the wealthier persons will be able to survive, but for the lower income group, they will suffer the most. Okay. So when there is no foreign trade or there is no imported goods, the domestic market will be out of hands. Like the producers will put any price on their product so that they can earn more wages. Sorry, profits. So this will adversely affect the majority of the population. So that is also a problem. Now, let's see the anatomy of foreign exchange rate. So you might have heard about this, right? The foreign exchange rates. So The foreign exchange rates show how or the value of one currency compared to another. So we have heard that many times, right? Like one US dollar is equal to 80 rupees, or one Kuwait dinar is equal to this, one pesos is equal to this, like that, right? So the exchange rates are mainly determined by demand and supply in global. Okay. So basically, for foreign exchange rate is the value of one currency expressed against another. Okay. And they are determined by the intersection of global market demand and supply. You can see here. So there are three main systems. We have floating exchange rate, managed floating exchange, and a fixed. So floating exchange rate is completely based on the market. Whenever the market demands more foreign currency, the price will hike, and when it doesn't want, price will plummet. Okay. At the same time, a fixed rate, at initially it was like this fixed, okay? The central bank will be fixing it. But the issue is that they won't be changing it regularly, which will cause some troubles. Now we have the managed floating, so that they will have some minimum and maximum levels. Okay. They will have minimum and maximum levels. In between, the rate can fluctuate. So if it crosses any of these limit, the government will interfere. Okay, so that is what we call as floating rate. Here, so it will have impact on international trade and investment. Okay. Now let's see what do we mean by appreciation and depreciation. These are the frequent words which is visible in newspapers and news channels very recently, right? So when a currency appreciates, its value increases. Okay. So as a result, export prices will be high and import prices will be low. Let's see how it has happened. For example, let's imagine that one USD is equal to 80 rupees equal to. Now one USD is equal to 60 rupees. Okay, which means we had to spend 80 rupees for buying a $1 product from another country. But now we only have to spend 60 rupees, which means imports become cheaper. But what about exports? So for a foreigner, they were able to buy uh, 80 rupees worth of things with the 1 USD. Now they can only get 60 rupees of worth things using their 1 USD, which means export become expensive. Got it? The price of export increases and the price of import decreases. That is what happens when a currency is appreciating. Okay. The value of currency increases. And the opposite happens when the currency value is falling. Export prices is low and import prices are high, which means initially 1 USD is equal to 80. Okay. Now 1 USD is equal to 120. Okay. Which means initially for buying a 1 USD valued product, we had to spend 80 rupees. Now we have to spend 120. At the same time, for a foreigner, they were only able to buy 80 rupees worth things using 1 USD, but now they can buy 120 rupees worth of products using 1 USD, which means export become cheaper and import become pricier. Okay, exports are cheaper. Clear? So this is how the depreciation and appreciation is worked. Now, let's see the drivers of currency fluctuation, how the currency is fluctuating. Okay. So as we know, several factors influence currency values, right? So we have like trade flows, the balance of physical and imports and exports, then inflation, that is the relative purchasing power changes, then the interest rate, the yields attracting or repelling global capital, and then we have foreign investment, the long-term capital development, deployment and acquisitions, and speculation, short-term traders sentiment and anticipation, right? So all these will have an impact on the currency baseline. Okay, so this is how the value will be changing. So these five macroeconomic pressures constantly shift the demand and supply curve, forcing exchanges to rate to seesaw the market. Okay, so it will be fluctuating in the market. So now let's see the floating and the fixed exchange rate in detail. So as we mentioned, for floating rate, it is ultimately flexible, right? Act as an automatic and economic stabilizer based on market forces. And what are the disadvantages? Breed uncertainty for businesses. We can't say that when it is going to peak, when it is going to uh, steep down, right? So highly vulnerable to aggressive speculation. And what about fixed rate? It provides absolute price stability and it is highly attractive to foreign investment and trade. But what are the disadvantages? It requires massive central bank reserves, severely limit independent government monetary policies. So that is the limitation. So what we need? We need a hybrid approach. That is why we have managed floating nowadays. Central banks allow market forces to dictate rates but intervene to smooth out extreme volatility. Okay, so they won't let any extreme values affect the exchange rates. Got it? Now let's talk about balance of payment. So the balance of payments record all economic transactions between a country and the rest of the world, right? So the current account includes the trade in goods, services, investment, income, and transfers such as remittance. It helps measure a country's international economic position. So the balance of payments has two accounts, right? The first one is current account. It includes all the visible trade like physical export and import of tangible goods, and the invisible trade like the export of and the import of services like finance, tourism, etc. Income flows such as cross-border earnings, dividends, and interest payments, and transfers like unilateral movements of money like foreign aid, remittances, etc. Okay, so now let's see deficit versus surpluses. Okay. So a trade deficit happens when imports are greater than exports. Okay. A trade deficit occurs when an import are greater than export. So this can increase inflation and reduce national reserve over time. And what about trade surplus? Trade surplus occurs when export exceeds imports and surpluses support economic growth, increase reserves and strengthen the economy. So both deficits and surpluses affect long-term economic stability. So that is why the government is always trying to balance it. Okay. And we have macro stability feedback loop, right? So we can see how exchange rate, trade dynamics, and the balance of payments are interconnected. So the changes in the currency value affect the exports and imports, and trade balances then influence currency demand again. So this creates a continuous feedback loop and that helps economies move towards equilibrium over time. Okay, so we have trade dynamics, balance of payments, and exchange. So exchange rate include currency fluctuations with the resets relative import-export prices, and the trade dynamic includes import and export competitiveness dictates ledger state. And we have the balance of payments, right? And the self-adjusting global mechanism will ensure the stability of the system. Got it? And the government economic policies, how the government manages it. We have supply side policies, the interventions designed to increase fundamental economic efficiency, productivity, and long term. Then we have the fiscal policies, right? Government adjustment to taxation and public spending to directly influence demand and the balance rate. So what are the tools used here? Public spending. Okay, government spending and taxation. Okay. So when there is more money, they will increase taxation and reduce spending. When there is less money flow in the economy, they will reduce taxation and increase their spending. And the monetary policy is done by the central bank, right? So central bank manipulation of interest rate and the money supply to stabilize inflation and the foreign exchange rate. That is what we call as monetary policies. Okay. So government utilizes these synchronized levers to intervene when macro stability loop breakdown. Okay. And correcting deficits, combating inflation, maintaining systematic stability across the global footprint. So the health of an economy is very much needed for a smooth functioning of a country, right? For their businesses, export, imports, and other revenue related earnings, spending, etc. For all, we need a stable economy. So that is why we have to make sure everything is balanced smoothly. So this is how you have to learn the topic. I hope it is clear for everyone. Thanks for watching.